Hey there, Scott Webster here. I want to touch on mortgage interest rates and the Fed, so stay tuned. If you're interested in mortgage rates, there's one thing you should keep in mind. The Federal Reserve's actions play a huge role in determining them. In fact, the sentiment about the Fed changes, so do mortgage rates. Let's recap here just a little bit. So when we talk about the Fed and rates, we're referring to rates on auto loans, credit cards, and home equity line of credits. Now, of course, mortgage rates are indirectly affected, so we watch the Fed's words and actions closely. But right now, it looks like the markets are leaning toward the Fed being forced to pause hiking their rates in May, with about a 60% likelihood of a pause. Now, just yesterday, it was a 50-50 chance of a rate hike, so the sentiment has shifted a bit more towards a pause. Overall, the markets are still anticipating the Fed will have to pause and then start cutting rates by September, with the Fed policy rate around 4.25 or 4.5 by December of this year. But here's the bottom line. If the markets become more convinced that the Fed is hogtied and will have to pause rate hikes and even start to cut rates, we will see mortgage rates improve. However, if it leads the other way and the markets feel that the Fed has more leash to work with and will continue to raise rates to fight inflation, mortgage rates will most likely go up. So keep an eye on what's happening with the Fed. It could have a big impact on your mortgage rates. And if you have questions or concerns, don't hesitate to reach out.